What if the world's most secretive hedge fund managers sat down and told you exactly how they really make money? Not theories, not textbook strategies, but the raw psychology, brutal losses, and mental rules that separate ordinary traders from people who quietly pull millions from the market year after year. In Hedge Fund Market Wizards, you don't learn what to trade. You learn how elite minds think under pressure, how they survive crashes, how they manage fear, and why discipline matters more than prediction. These traders didn't win because they were lucky. They won because they mastered risk, patience, and self-control while everyone else chased noise. This book isn't about beating the market once. It's about building a mindset that survives every market. And once you understand how hedge fund legends think, you'll never look at money the same way again. Chapter 1. The Real Edge of Elite Traders. Chapter 1 opens with a powerful truth. The biggest difference between winning traders and losing traders is not strategy. It is how they think about risk. The hedge fund managers interviewed in this chapter all come from different backgrounds. Some are mathematicians, some are discretionary traders, some started with almost nothing. Yet they share one mindset: survival comes first. They don't try to be right every day. They don't predict the future. They focus on not blowing up. One trader explains that most people lose money because they trade too big when they feel confident and freeze when they're wrong. Elite traders do the opposite. They assume they can be wrong on any trade and size positions small enough so mistakes don't destroy them. This chapter introduces the idea that the goal is not to make money fast. The goal is to stay in the game long enough for your edge to work. Another key lesson is emotional control. The best traders are not fearless. They simply don't let emotions decide their actions. They follow rules even when their instincts scream otherwise. Losses are treated as business expenses, not personal failures. Every loss is information. Every drawdown is a test of discipline. One hedge fund manager admits he learned more from a single massive loss than from years of small wins, because it forced him to respect risk permanently. By the end of Chapter 1, the message is clear. Markets reward consistency, not bravado. They reward process, not prediction. And the true edge of hedge fund wizards is not secret indicators. It is controlling downside, cutting losses, quickly protecting capital, and thinking in probabilities instead of hope. This chapter sets the foundation for the entire book. Before you learn how great traders make money, you must understand how they avoid losing everything, because in the markets, the trader who survives eventually wins. Chapter 2. Why Psychology Beats Strategy. Chapter 2 reveals a surprising pattern. Many of the world's top hedge fund traders use very different strategies, but they all share the same mental habits. Some trade fundamentals, some trade charts, some trade algorithms. Yet they succeed for one main reason: they control themselves better than they control the market. This chapter shows that most traders fail not because their strategy is bad, but because they can't follow it. They panic when prices move against them. They get greedy when they win. They abandon rules after one emotional mistake. Elite traders build systems to protect themselves from their own emotions. They define risk before entering a trade. They know exactly where they will exit if they're wrong. And they never increase position size just to win back losses. One trader explains that confidence is dangerous if it is not paired with humility. Markets don't reward ego. They punish it. Another powerful idea in this chapter is independence of thinking. Great traders don't follow news headlines or crowd opinions. They look for situations where the market is emotionally mispricing reality, where fear or excitement has pushed prices too far. They wait patiently for those moments, and when they act with precision. This chapter also introduces the concept of drawdowns as a test of character. Anyone can trade when they're winning. Only professionals can trade properly while losing. Instead of changing strategies after a few bad trades, top hedge fund managers ask, "Is my logic still valid?" If yes, they stay disciplined. If no, they exit immediately. By the end of Chapter 2, the lesson is clear. Markets are not beaten by intelligence alone. They are beaten by emotional control. The real enemy is not volatility. It is impulsive behavior, and the trader who masters their mind eventually masters their money. Chapter 3. The Power of Patience and Timing. Chapter 3 focuses on a skill most traders underestimate: waiting. The hedge fund managers in this chapter explain that real profits don't come from trading all the time. They come from trading at the right time. Most people believe success means constant action, but elite traders believe success means selective action. They wait for moments when the odds are clearly in their favor, when price, fundamentals, and market psychology align. Until then, they do nothing. One trader compares trading to hunting. You don't fire at every movement in the forest. You wait for the clean shot. This chapter also highlights how timing beats prediction. Top traders don't need to know where the market will be in a year. They only need to know when the current move is wrong or exhausted. Instead of asking, "Is this a good company?" they ask, "Is this a good trade right now?" Another key idea is that missing trades is part of winning. Elite traders are comfortable watching big moves happen without them, because they know forcing trades leads to losses. They protect their capital and their confidence by avoiding mediocre setups. This chapter also shows how professionals adapt to changing market conditions. They don't marry one opinion. They stay flexible. When the market changes, they change. By the end of Chapter 3, the message is sharp. Profits come from discipline, not activity; from waiting, not chasing; from patience, not prediction. In the markets, doing nothing is often the smartest move until the perfect moment arrives. Chapter 4. Risk is the real strategy. Chapter 4 makes one thing clear. Great hedge fund traders don't think in terms of profits first. They think in terms of losses first. Before entering any trade, they ask one question: how much can I lose if I'm wrong? This chapter explains that position sizing is more important than market direction. You can be right about the market and still lose money if you bet too big. The traders interviewed describe risk as something that must be engineered, not guessed. They calculate exposure. They limit how much capital is at risk per trade, and they structure trades so no single mistake can destroy them. One powerful lesson is that volatility is not danger. Overexposure is. Markets can swing wildly and still be survivable if risk is controlled. But even small moves can be fatal when leverage is abused. This chapter also talks about the danger of emotional risk-taking. After a win, traders feel invincible. After a loss, they feel desperate. Both emotions lead to oversized bets. Elite hedge fund managers fight this by following fixed risk rules: same risk on good days, same risk on bad days. Another idea introduced here is that risk management creates freedom. When losses are limited, fear disappears. When fear disappears, decision-making improves. By the end of Chapter 4, the core lesson is unmistakable. You don't survive markets by predicting better. You survive markets by losing better. Control your downside, and the upside will take care of itself. Chapter 5. Learning from Losses. Chapter 5 dives into a truth most traders try to avoid. Losses are the real teachers. Every great hedge fund manager in this chapter admits they've had painful failures, blown trades, wrong calls, and periods where nothing worked. What separates them from ordinary traders is not avoiding losses, but studying them. Instead of hiding from mistakes, elite traders analyze them like scientists. They ask, was my idea wrong? Was my timing wrong? Or did I break my own rules? Losses become data, and data becomes improvement. One trader explains that the market punishes emotional reactions more than bad ideas. Revenge trading, overtrading, and doubling down after a loss destroy more accounts than bad strategies ever could. This chapter also shows how top traders build emotional resilience. They don't attach their identity to a single trade. A loss does not mean I am bad. It means this trade didn't work. By separating ego from outcome, they stay rational under pressure. Another key lesson is adaptability. Markets change. What worked last year may stop working this year. The best traders constantly evolve, not because they panic, but because they pay attention. They treat trading as a career of continuous learning, not a shortcut to quick money. By the end of Chapter 5, the message is powerful. Every loss contains a lesson. Every mistake is a mirror. And every drawdown is either a disaster or a doorway to mastery. The traders who grow rich are not the ones who never lose. They are the ones who learn faster than they lose. Chapter 6. Developing a True Trading Edge. Chapter 6 answers a question every trader asks. What actually creates an edge in the market? The hedge fund managers explain that an edge is not a magic indicator or secret formula. An edge is simply a situation where the odds are slightly in your favor, and you apply it consistently over time. Some traders find their edge in fundamentals, others in technical patterns, others in macro trends or volatility. But the source doesn't matter as much as one thing. They fully understand why their approach should work. They don't copy strategies blindly. They test them. They observe them. They refine them. This chapter stresses that you must trade a method that fits your personality. A patient person will struggle as a day trader. An impulsive person will struggle as a long-term investor. Great traders design systems that match how they think, how they handle stress, and how they process information. Another key idea is simplicity. The most successful traders don't build complicated systems. They focus on a small number of repeatable setups and master them deeply. They would rather know one strategy extremely well than know 10 strategies poorly. This chapter also highlights the danger of overconfidence. When traders believe their edge is permanent, they stop managing risk. And when risk management stops, failure begins. The best hedge fund managers constantly assume their edge can weaken, so they stay alert. They stay flexible. They stay humble. By the end of Chapter 6, the lesson is clear. Your edge is not what you trade. It is how well you understand why you trade it. Markets reward clarity over complexity, consistency over creativity, discipline over brilliance, and the trader who builds a real edge builds a business, not a gamble. Chapter 7. The discipline to stick with the plan. Chapter 7 focuses on the hardest skill in trading, doing the right thing consistently. The hedge fund managers explain that having a good strategy is useless if you abandon it under pressure. Most traders don't fail because their ideas are bad. They fail because they break their own rules. They move stop losses when they feel hopeful. They take profits too early when they feel afraid. They hold losers too long because they don't want to be wrong. Elite traders design rules specifically to protect themselves from these instincts. This chapter shows that discipline is not about willpower. It is about structure. Great traders remove emotion from decisions by planning in advance. Where they will enter, where they will exit if wrong, where they will take profit, how much they will risk. Once the trade is on, the job is simple. Follow the script. Another key lesson is routine. Top hedge fund managers treat trading like a profession, not a casino. They review trades daily. They track performance. They analyze mistakes. Their confidence comes not from winning trades, but from trusting their process. This chapter also highlights that discipline becomes most important during losing streaks. Anyone can follow rules when things are working, but only professionals follow rules when things are failing. That is when most traders self-destruct by changing systems, increasing size, or chasing losses. The best traders do the opposite. They trade smaller. They become more selective. They protect their capital and their mindset. By the end of Chapter 7, the message is firm. Success in markets is not about brilliance. It is about consistency. Not one perfect trade, but thousands of well-executed ones. And the trader who can control their actions will eventually control their results. Chapter 8 explains that elite hedge fund traders succeed because they think in probabilities rather than predictions. They do not judge themselves by the outcome of a single trade, but by whether they followed their process correctly over a long series of trades. A good trade can lose, and a bad trade can win, which is why emotional reactions to individual results are dangerous. Instead of asking if a trade will work, professionals ask if it fits their edge and risk rules. They accept uncertainty as part of the business and understand that randomness cannot be avoided, only managed. By focusing on consistency, discipline, and statistical thinking rather than hope or fear, they turn trading into a game of controlled odds instead of emotional gambling. Chapter 9 emphasizes the importance of adaptability and continuous learning in trading. The top hedge fund managers understand that markets are constantly changing and strategies that worked in the past may not work tomorrow. They maintain an open mind, constantly test new ideas, and refine existing approaches based on experience and results. Rather than sticking rigidly to one method, they adapt to evolving conditions, learning from both successes and failures. The chapter also highlights that self-awareness and humility are critical. Knowing your strengths, weaknesses, and emotional triggers allows traders to make better decisions under pressure. Ultimately, the chapter shows that survival and long-term success come from being flexible, disciplined, and committed to improvement rather than relying on fixed formulas or past performance. Chapter 10 focuses on the critical role of focus and specialization in building a trading career. The top hedge fund managers all emphasize that trying to master every market or strategy is a recipe for mediocrity. Instead, they concentrate on areas where they have a genuine edge, whether it's a specific asset class, trading style, or set of market conditions. By narrowing their focus, they can analyze deeply, execute consistently, and exploit inefficiencies that others overlook. This chapter also highlights the importance of developing unique insights rather than copying others. The most successful traders create their own frameworks for interpreting the market. In the end, Chapter 10 reinforces that consistent success comes not from being everywhere at once, but from being exceptionally skilled and disciplined in the areas where your strengths lie. Chapter 11 delves into the personal habits and philosophies that separate the best hedge fund managers from the rest. Beyond strategy and risk management, success in trading comes from self-discipline, patience, and emotional control. The chapter highlights how elite traders structure their daily routines, maintain mental clarity, and develop the resilience to handle both large wins and significant losses without being swayed by greed or fear. Many of the traders interviewed stress that wealth is a byproduct of consistent process, not chasing short-term gains. They treat trading as a professional craft rather than a game of speculation, continuously refining their methods, learning from mistakes, and embracing a long-term perspective. The chapter reinforces the idea that mastery in trading is as much about character and mindset as it is about technical skill or market knowledge. Chapter 12 serves as the culmination of the lessons shared by the hedge fund legends. It emphasizes that success in trading is not about finding a secret formula or predicting the market perfectly, but about mastering yourself, your risk, and your process. The chapter revisits key themes: controlling losses, thinking in probabilities, sticking to rules, learning from mistakes, and continuously adapting. Many traders note that humility, patience, and consistency are what allow them to survive over decades of volatile markets. They stress that wealth is a byproduct of disciplined action, not luck or bravado, and that those who treat trading as a craft rather than a gamble consistently outperform. The outro reinforces the overarching message of the book. The true market wizard is not the one who wins every trade, but the one who survives, learns, and improves over time. By focusing on process, risk control, and mental mastery, any trader can increase their chances of long-term success. The book leaves readers with a mindset shift. Trading is less about prediction and more about self-discipline, adaptability, and probability-based decision-making, and adopting this approach is the real edge that separates legendary traders from the rest. As we close the pages of Hedge Fund Market Wizards, one truth becomes unmistakably clear. The market does not reward luck, bravado, or wishful thinking. It rewards discipline, patience, and mastery over yourself. The legends we've studied did not become successful because they predicted perfectly or chased every trend. They became successful because they managed risk, learned from mistakes, and stuck to a process under pressure. Trading is a test of character as much as it is a test of skill. Every loss is a lesson. Every drawdown is an opportunity to grow, and every well-executed trade is a reflection of preparation, humility, and self-control. The path to consistent profits is paved not with shortcuts, but with habits that protect capital, sharpen judgment, and strengthen mental resilience. Remember this: the market's greatest edge is not in charts, systems, or formulas. It is in your mind. Master yourself, master your risk, and the opportunities will follow. The hedge fund wizards we've learned from are proof that long-term success comes to those who think strategically, act decisively, and above all, survive to trade another day. If you take one thing from this book, let it be this: consistency beats genius, preparation beats prediction, and patience beats impulse. Apply these lessons, and you can transform not just your trading, but the way you approach every challenge in life.